Hello, my name is Prabhat, and I have two more colleagues here with me from National University of Singapore, and we'll be talking about applications of deep reinforcement learning in stock trading. So, a quick introduction about the team. I have Khurshid here with me, who is doing his Master of Computing in Artificial Intelligence, and I also have Preetam, who is doing Master of Computing in Computer Science, and he's working in banking technology with Barclays Bank. And I'm also doing Master of Computing in Computer Science from NUS, and I'm working in an AI company named KReply. Okay, so this is the outline of what we are going to discuss today. So during project for course CS 5446, we surveyed 3 papers, and we are going to talk about our findings on those 3 and what we conclude from it. All right. So we all know that stock market is quite dynamic and can be very complex. So stock trading and liquidation strategies play quite a crucial role in investments. Researchers usually explore the use of deep reinforcement learning agents to create optimal strategies for stock trading. And during this presentation, we'll survey the 3 papers that I mentioned earlier. 2 of them are related to automated stock trading, while the third one is covering the analysis of liquidation strategies. The first paper is a practical deep reinforcement learning approach for stock trading. So I'll be talking about this paper in a bit more detail. What it contains is it explores the use of deep reinforcement learning. We'll refer it to as DRL algorithms going forward. So one such algorithm is deep deterministic policy gradient, or DDPG, which is used to optimize the stock trading strategy. The trading process in this paper is modeled as a Markov decision process, or MDP, and the agent's goal is defined to maximize the returns. It's aligned with what we would usually want in the real world to maximize the returns of the stocks that we trade with. So in this paper, the features of a particular state in MDP is represented using stock price, stock holdings, and the remaining balance. The actions for the MDP are same as the real world scenario, which is to sell a stock, buy a stock, or hold a stock. So in the paper, the authors had concluded that a trained DDPG agent can outperform any other existing trading strategies in accumulated returns. So they also verified it using increase in Sharpe ratio. Sharpe ratio is a metric used in finance to check whether the returns of a particular investment is higher or lower than what is included in a risk-free investment or strategy. As we surveyed the paper, during the survey, we found that DDPG agent can perform in a similar way as to what has been mentioned in the paper. So what I used is I trained a DDPG agent on the same Dow 30 data set, which was used in the paper, and then compared the results. In the beginning, I found that the performance was a bit lower than what it was earlier, or what it was given in the paper. The agent was then trained on different other data sets with enhanced preprocessing or tuning of hyperparameters. And then I found that the results of this hyperparameter tuned data set or highly preprocessed data set is even better than what it is given in the paper. So I was able to obtain higher returns and a higher Sharpe ratio for it as well. This is a table summarizing. So the first 2 columns here are for the results which are from the paper. And then the remaining columns are from the survey that I conducted. So in the paper, the initial portfolio value was chosen as $10,000. And it was seen that the annualized return of 25% was achieved and Sharpe ratio of 1.79. They had compared it to the existing strategy, Dow Jones Industrial Average, which had a lower return as compared to the DDPG agent trained return, and that was of 11% and the Sharpe ratio of 1.27. When I trained the DDPG agent on the same data set, although using a different implementation, because the authors of the paper have not made the code public for what they had done. So I selected code from somewhere else related to the DDPG algorithm implementation itself. And it gave a slightly lower annualized return of 23.67%, a Sharpe ratio of 1.4. So I tried to use different values, like for the initial portfolio value, I increased it to 1 million. It further decreased the annualized return in the beginning, but after I used feature engineering pre-processing and then applied the DDPG agent, then I was able to get results which are even better than what was mentioned in the paper. So here we see that the returns were from 36% to 46%, and the Sharpe ratio went to as high as 2.15. This chart here is from the paper itself. It shows the trend of portfolio value, which was obtained through the trained DDP agent. So you can see the difference is quite high as compared to the traditional strategies of min variance or the Dow Jones Industrial Average. The graph here is from reproducing the same behavior on the same data set. We'll see that the gap here between the two trends is slightly lower than what we saw in the previous slide. Okay, so this trend is from the results obtained after doing the enhanced pre-processing and tuning. And we see that the returns are much higher than the baseline in this case. So to conclude, the survey and the evaluation confirms that a trained DDPG agent can outperform other strategy. So I concur with what is mentioned in the paper, and the same was reproduced as well. I also found that the results vary with different pre-processing and different tuning techniques. The authors didn't explore this in a lot of detail within the paper, and their research was limited to just a single data set. But nevertheless, the paper is an inspiration for further research on usage of different DRL algorithms for stock trading. Some of these algorithms are explored further in the survey of the second paper, and the third paper will see how single agent versus multi-agent strategies are used. Okay, so with this, I'll pass on to my colleague Khurshid, who will continue with survey details of paper 2.
So hello, I'm going to talk about DRL, the Deep Reinforcement Learning Library for Automated Stock Trading in Quantitative Finance. So the main question of the authors is that the main concern of the authors is that pre-existing libraries are complex and not flexible, and therefore the majority of results achieved by academia were not reproducible. So now they introduced a good and complex and now a better library to reproduce, to be able to reproduce the results. Next slide. So according to the authors, and as you observed, the DRL comes with 3 good characteristics, like completeness, which means that it includes all the possible environments and all the possible strategies and all the possible parts to be able to implement full-fledged model on a simulation close to the reality. It also contains hands-on tutorials of different difficulty and helps with different purposes. And also it can highly reproduce the results and achievements achieved by academia. Next slide, please. So talking about tutorials, as you can see, so tutorials are divided into 4. So introductory tutorials, which is very beginner friendly, easy to run, and runs practically on every machine, even without a GPU. There is advanced tutorials, and practical tutorials, and finally optimization tutorials, which will help with coming up with hyperparameters needed for achieving good results. Next slide, please. So this is the architecture of the library. It has 3 layers. It has application layer, it has agent layers, so divided into 2 again, conventional RL agents we've seen in the lectures, and also deep reinforcement learning agents. And also it contains financial market environments. As you can see, the library is highly modular. You can take one working model and replace it with different agents. You can put another, you can use your models in different downstream tasks. Also, you can produce different environments. And therefore, it gives better market environment modeling. Next slide, please. As I said, so the library offers different environments, and all of the environments are based on OpenAI's Gene framework. So all of them basically are time-driven trading simulators. They usually contain state space, action space, and reward function, which is really necessary if you're working on with market decision processes. State space contains or may contain any of or all of balance, own shares, closing, opening, or high-low prices. It may also contain trading volume, some technical indicators like moving average, convergence, divergence, or some indicators related to risk. And also it contains time granularity, which can come in terms of like minutes, hours, or days. So we can work with different time granularity. Action space contains of -1, 0, and 1, corresponding to selling, holding, and buying a unit of a stock. Or alternatively, we can have a set of -k to k. -k corresponds to selling k units of a stock, and k corresponds to selling a k units of that stock. And reward function can be implemented differently. It can be a portfolio change, log return, or any positive marker of a good performance defined by academia, or users they themselves can define it using their Python code. Next slide, please. So finally, hyperparameter tuning made it really easy with integrating with instruments like weights and biases. So they give callbacks and necessary listeners for 2 models during the training phase, so that we can tune hyperparameters and reproduce the results we want. And this concludes the second paper.
Hi, I'm Preetham, and I'll be talking about the third paper, multi-agent deep reinforcement learning for liquidation strategy analysis. What do we mean by liquidation? So liquidation is the process of selling a large number of stocks of a single share sequentially in the market, and we have to take into consideration the risk aversion that a particular liquidator has and the costs and the risks that might arise when he is doing the trades. So there might be a difference when he decides to actually make the trade and the time when the trade is actually executed. So that difference is captured in the trading cost, or like you can say like the expected trading cost, and we technically we call it the implementation shortfall, which we would want to minimize in order to have an optimal trading strategy. So suppose as a liquidator, I have like 100,000 stocks of Google. I would want to liquidate them over a time period of say 40 days. I would want to minimize my trading cost. And that is what this paper is trying to do. And we try to analyze how DRL techniques, specifically DDPG algorithm, is able to train agents in both single agent and multi-agent scenarios, so that we can get the optimal trading strategy. So here liquidation in the stock market is modeled as a Markov decision process. And we, as I said, like we use both the single agent and multi-agent settings. And the stock price fluctuations in the environment are actually simulated using the Almgren risk model. So Almgren-Price model actually talks about how the stock price, when we are making these liquidations, is varying according to like the permanent impact and the temporary impact and the volatility and the drift in the market, how they are having an impact on the stock price, because we are going to do it like sequentially. Yeah, so DDPG algorithm, as my colleagues spoke about before, is going to be used as well here. So DDPG algorithm uses like an actor critic model as opposed to the DQN algorithm, and it helps in learning of the agents. And in terms of the evaluation, which we'll see ahead, the authors try to see if there is any bias introduced in a multi-agent environment against the optimal trading trajectory that is obtained in a single agent environment. So by optimal trading trajectory, what we are going to try to capture is basically the fraction of the shares that are being sold in every step of the like a 60-day time period. So like on the first day, I'm going to sell like 1/3 of my whole shares, and the next day I think that the price is not good, so I don't sell anything. And on the third day, I can sell, suppose, 1/10 of my shares. So like that. So and the expected shortfall in a multi-agent environment is also compared between in a multi-agent environment in a cooperative as well as a competitive setup. So this is an interesting analysis, at least for me. So what we see is the reward function is adjusted, and we see that in a competitive environment, how the agents behave differently as compared to a cooperative environment. Okay, thank you. So here we see how the liquidation is formulated as an MDP. So these are the standard definitions. So like the state space is basically a vector of three quantities. So the first is a log return. So it's a log return of like in the numerator you have log of RT plus 1 and denominator RT. And the second quantity is the remaining number of trades M, and it's normalized by the total number of trades. So suppose if a liquidator has 500,000 shares to sell, at every step, at every state, we are going to normalize the amount of trades that he has to he still has to execute. And the third quantity is the remaining number of shares to sell, and that is also normalized according to the total number of shares that he has to sell. The next thing is the action space. So the action is actually expressed as a fraction of the number of shares that he has to sell at a particular time step. And there are two kinds of actions that he can take. He can not do anything because he decides that the price is not right for him to liquidate, or the other action can be just a fraction. So it can be 0.1. So he's going to liquidate 1/10 of his total portfolio. The utility function is defined like, as you can see, like EX plus lambda VX, where lambda is showing the risk aversion of the particular liquidator. EX is a quantity which shows the stock price change due to the permanent and temporary impacts as defined in the Almgren-Price model. And VX is the stock price change. That is basically the impact on the stock price due to the volatility and drift in the stock market. The reward function, the reward function is basically just UT minus UT plus 1. We just take the difference of the two utilities in two time steps. Thank you. Yeah. Okay, so we observed three evaluations. So I used the official code that was provided by the authors, and I ran the Jupyter notebooks myself. Certain modifications were necessary in the Python scripts in order to for the various simulations that we ran. So I'll just share what I observed. So in this setting, a single agent who had to liquidate 1 million shares with a risk aversion of 10 to the power minus 6, and that is compared with a two-agent environment where two different agents, one having 0.3 million shares to liquidate and the other having 0.7 million shares to liquidate. Every one of them have the same risk aversion in this scenario. And one major assumption which I thought which would be a little different from a real world scenario here is the risk aversion stays the same throughout the lifetime of the liquidation, which probably is not the true in a real world scenario, because you would want to change your exposure. But yeah, so what we see is the total expected shortfall in a single agent setup is actually greater than the sum of the two expected shortfalls in the multi-agent environment. Next slide. Yeah, for the second evaluation, we see two separate single agent environments. The only differing factor here is the risk aversions. One has 10 to the power minus 4 and one has 10 to the power minus 9. And we compare this setup with a two agent environment where the agents have the exact same risk aversions, just that now they are operating together in an environment, and all of them have 500K shares to sell. So we plot the optimal trading trajectory in all the 4 setup, and this is what we observe. So we see that in the multi-agent setup like B1 and B2, which is shown by the red and the green plots, there is a certain bias introduced as compared to the single trading trajectory setups. And why does this happen? It is because like the agents B1 and B2, they cannot operate independently. They have to consider the presence of the other actor in the environment. So this is why we see the bias, and we can confirm this observation. Okay, in this one, this is the interesting evaluation which I was talking about. So we compared 2 multi-agent environments, one where the 2 agents are in a competitive setup, and the other where the 2 agents are in a cooperative setup. So what we so everything is the same. They all have 500K shares to sell, and all of them have the same risk aversion. In the cooperative setup, what we observe, it's not necessarily better than a single agent setup. And what we also observe is in a competitive setup, eventually one agent learns to outperform the other. So at the start, they're performing at the same level, but during the training of the exercise, like after 4,200 episodes, one agent eventually learns to outperform the other. And why does this happen? It's kind of intuitive. It is because of the mutual competition, none of them kind of benefit. Either one of them always wins, kind of the scenario. And the 2 environments are only different in terms of the definitions of their reward functions. Like in the cooperative setup, irrespective of whichever agent is winning, both of them get rewarded. Like as you can see, it's the arithmetic mean of the 2 reward functions for the next time step. And in the competitive setup, the agent who has a better reward actually retains that reward, whereas the agent who actually has a lesser reward is further penalized because his next reward becomes the negative of the difference of the 2 rewards. So the next slide. Okay, so finally, I'd just like to conclude this paper. So just to round up, all the simulations that we saw in the previous evaluations actually ran for like 10,000 episodes. And like for the authors did not see it fit to like run for even more episodes, because apparently the results were also 20% better than those that were derived theoretically using the Almgren-Christ portfolio model. And this also establishes that DRL methods can be used to better train and design optimal trading strategies in the stock market to maximize the cumulative returns as compared to the traditional financial modeling methods that are probably more used in the market as at present. But I think further scope of research is still there in this field. Like, for example, we can make the MDP much more sophisticated by capturing more dynamic variables in the state vector. And like, since we take the Almgren-Christ model here as the environment pretty much, which is determining how the stock prices are changing, we can use some other models which are also existing to simulate this whole experiment. That can be. Yeah. Next slide. Okay, so finally we come to the conclusion of the whole survey. So I'll just like to sum up all the 3 papers and conclude our presentation. So just to compare DRL techniques versus the traditional modeling methods, I think what we have learned through the previous papers as well as the liquidation paper is that DRL techniques can be used to get better trading strategies, better returns, better gains than traditional modeling methods, and it can be used in future with further experimentation to derive optimal trading strategies. However, what we learned is DRL algorithms are highly sensitive to hyperparameters and they need to be highly tuned, and minor variations in those parameters can actually cause the results to be highly different. And as is obvious, the authenticity of the obtained results of course depends on the ability to simulate dynamic and stochastic nature of the real world stock market. And there is a huge scope for future research in this field, as DRL methods, I think, are not so commonly used at present in order to simulate like automated trading or liquidation by hedge funds. So there is a lot of scope for future work in this field. And I'm sure like in the upcoming days, it will become like one of the go-to areas of research, as well as like we will see some real world implementation as well. With that, I'd like to conclude the presentation. Thank you.